And a big welcome to our live audience for the Digital Health Investor Talk show. I'm your host, Stephen Wardell. I'm the managing partner of Wardell Advisors, a digital health and advisory firm, and the author of The Future of Digital Health. Wardell Advisors is helping digital health companies address issues around growth, fundraising, trade sales, and strategic alternatives, giving you more options in today's challenging environment. You can follow me at x.com/Stephen Wardell. Our show topic today is, will GenAI win this time? GenAI business models in healthcare look different than the digital health revolution of 2009, which was about SaaS and workflow automation. And we look at whether the new models can win in healthcare this time. This show is being recorded and will be included in my podcast series called the Digital Healthcare Investor Talk Show. Subscribe to our podcast on Apple and Spotify and leave us a review. This is not investment advice, and we are not investment advisors. Here's a note about today's show. The show is 90 minutes long, and Marco and I will spend the first part discussing the news and the macro picture and some other topics. And then for the second half of the show, we'll cover our special topic of the day. And we'll be able to answer your questions throughout in the LinkedIn text chat. Marco, welcome to the show.
Thank you for having me.
So can you briefly introduce yourself to our audience?
Sure. My name is Marco Smit. I'm Dutch and French. I lived in the US for the past 20 years. I'm a serial entrepreneur and executive in healthcare and life sciences. I've had leadership positions in large public companies, Genentech and Affymetrix come to mind, as well as startups. I've had multiple exits. And what I do and what I'm about is my passion is really to get early stage innovation to take off, to scale. I've had success with doing that with companies as diverse as therapeutics companies like Genentech and small platform companies in digital health, real-world evidence, and AI. In my experience, most startups don't die because they have a lack of technology innovation, but a lack of finding their scaling groove fast. And being late is the same as being wrong, according to Mark Anderson, and being early is also the same as being wrong. And my point of view is I thrive on the innovating on the intersections between the innovator and the customer, and between what we have today and what could be. That is what I'm all about, and that's why I'm excited to be here.
Really interesting. Thank you. Well, so now we move on to the section of our show where we cover macro news. This is like index levels, inflation, interest rates, jobs, unemployment, that sort of thing. We used to live in a blissful time when the innovation economy didn't have to care about these things, but now they actually matter a lot to people. And so the first news is that the Fed held their two-day meeting. It ended today, and they decided to keep rates constant. And this is in a context where a lot of people would like lower rates, and Trump especially was doing the unusual thing, not unusual for him, but the unusual thing for presidents of criticizing the Fed and telling them what to do to cut rates. And so the Fed chose not to, and that's almost certainly because of continued concern about inflation. And inflation is a real bear, and we don't want excessive inflation. From the perspective of young company leaders in digital health, they're trying to raise money, and cutting rates would be very good for the innovation economy. It would be good in a couple of ways. It would be a form of stimulus for the economy. We don't want to go into a recession, and it would be good because it makes alternatives to growth investment less attractive. So if you can get 5% in risk-free government bonds on your money and 10% in corporate bonds on your money, then there's no need to lock your money up for 8 years in a venture fund and seek venture growth returns. And so the innovation economy would like to see rates cut, but the Fed is sort of holding the line strictly on inflation. In the innovation economy, young company leaders have had 3 years of terrible growth fundraising environment, and it's thought that cutting rates would make the fundraising environment a little better. And so we're not getting that from the Fed. We're not getting a stimulus that could lead to the fundraising environment getting a little better from the Fed. So that's a disappointment. So Marco, any thoughts on what the Fed did today?
Well, I haven't had a chance to really look at it in detail, but what I did see was some chatter that the Fed partially wasn't sure what was going to happen with tariffs and how to respond to it. And I think that is in light of all these other geopolitical events as well, right? So at the end of the day, it's not as simple as there's one stable economy or stable environment with one variable that changes. There are too many variables changes at the same time. So I think the best thing in their mind seems to be to do nothing until there's clarity.
Yeah, that's a good point. And so Trump has, with great fanfare, started a tariff war with other countries. But then and that makes people very concerned about inflation in America, because if our goods have a new tax placed on them, that would make them more expensive. If goods from China have a high tax placed on them, that would make them more expensive. But the counter to that is that he seems to want to do a quick deal for an increased tariff, but not for a cataclysmic tariff. But nevertheless, tariffs are inflationary, and that could help explain why the Fed chose to be cautious and not cut rates. So, and also market gyrations. So we've seen a lot of uncertainty in the stock market. I think it's driven by exactly what you said, which is that a lot of big fundamentals are all changing at the same time. Are we going into a recession? Is AI going to hurt the SaaS stocks, which are a big part of the NASDAQ? Are we going into war? Other issues like that. And so what's been remarkable to me is the NASDAQ is back up at about 19.5 thousand last I checked. That means in the last 2 years, it's gone up 100%. And that means that for your friends to consider you to be a stock market genius, all you had to do was just hold the NASDAQ for the last 2 years. And if only we had known in retrospect, and a lot of that is driven in turn by the Magnificent Seven or FANG or whatever it's called these days, which in turn gets a lot of its lift from an AI story that has not driven cash flows yet. So it's an AI story of future promise that has not delivered earnings yet. But I am surprised. So much mixed news, some bad news in there, and yet the market has been up. It's been gyrating, and it's been up the last couple of weeks. And I think that the stock market up could be a couple just the last day or two. Could be the belief that the Iran war won't escalate to be so. What it could escalate to Iran cutting off the Persian Gulf and cutting off the Red Sea, which would be bad for oil prices and trade and would be an international calamity. So I think this is a belief in the stock market that Iran won't escalate to do those things. And also that the tariff war is going to end in a negotiation with a moderate increase in tariffs. So anyway, any reaction to that, Marco?
Yeah, I think particularly on the tariff side, my guess is that part of the thinking is first of all, he has postponed tariffs over and over again. All right. So, and I think I'm not going to mention a certain abbreviation that people use, but maybe that's what they're thinking is he's going to keep pushing out. He's using it really as leverage to initiate negotiations. I think the second part too is ultimately, even though, some trade deals are announced on paper or in the press, at the end of the day, nothing is a trade deal until it gets ratified by Congress, and nothing is going to happen very fast over there. So my guess is that the street is kind of pricing in that there's going to be a lot of public relationship or public churn, but very little on the ground change with these tariffs for a while. So my guess is that that's what they've kind of baked in at some point. There's going to be 10% tariffs across the board, and everything else is going to be subject to change for a very long period of time. So my guess is that that's one half. And I think the other half is we've had so many kind of huge drops in the stock market that I think there is almost a wishful thinking maybe where people want to see positive news, even when as long as there's no negative news, it's positive news, which may be a little bit over optimistic, but you can see, right? People thought that the ban on selling GPUs to China and so on would really crimp NVIDIA's growth, and then they came and blew all the sales numbers away, right? So I think there is, and maybe a final comment is, I think with tariffs coming, there's also a lot of consumers and businesses have been hoarding and trying to pull forward purchases. So I think the second part that is difficult for Wall Street to interpret is what is temporary, just pulling forward of demand that's going to down for collapse later on, because I already basically purchased for the whole year prior to the tariffs kicking in, versus what is actually sustainably growth in demand, right? So how much I'm looking at an artifact versus how much am I looking at something that is just a trend. So it's going to be a bit difficult and up and down for a while.
Yeah, really interesting. And this is something I've actually heard from two other people and that I've done myself, what you just mentioned, and it could be of interest to our audience as well, which is that we have accelerated purchases. So for a household, this could be as simple as that you were going to get a replacement laptop sometime in the next year. And so you get it now so that you don't have to pay a big tariff on a laptop price. And so, but I've heard people doing this. Literally, people have asked me for advice on what laptop to get. So they buy it now so that they don't get hit. They don't make a mistake by 1 month and get hit with a 40% tariff or something.
Yeah,
So
I bought a European car late last year, partially in light of these tariffs, and they obviously figure out that you have two cars. So now every month I'm getting, here are the latest pre-tariff deals. Would you want to replace your second car? So it's very interesting. I think a lot of businesses are seeing this demand and they're tapping into it. They're feeding this kind of urgency, whether it's artificial or not.
And then just some other issues out there. So one is a delayed recession coming due. So usually we don't get to skip the business cycle. We don't get to skip over recessions, but we have not officially seen a recession in a long time. And people think that was because of war spending under Biden, that Biden basically chose to spend on supporting Ukraine in its war with Russia and supporting Israel in its war with Gaza and Hamas, and that this delayed a recession, but you usually don't get to skip them. And so the recession may be landing. And for young companies, this is bad because this causes buyers like big pharma buying tech or hospitals buying tech or payers buying tech to feel poorer and more uncertain about the future, so they spend less on tech. So that's another factor. And then another one is new war fears. We touched on that before, but that is that this new war with Israel and Iran could lead to a contagion effect, which would include closing the Strait of Hormuz to oil traffic and closing the Red Sea to general trade. And then also there's the big, beautiful bill before Congress. What this seems to show is that you have one of the more deficit hawkish administrations in a long time, especially compared to Biden. And when the first big spending bill comes up before Congress, it is spending a lot. It is doing the usual thing, which is putting everybody's pork barrel projects in the bill in order to ensure that it gets voted on by everybody. And that this is a problem because we have to refinance debt at higher rates now, and we have credit agencies downgrading the U.S. credit. And then if the government is spending this much, it has a natural effect of crowding out possible investment in private initiatives in healthcare, and among other things. So that's concerning as well. So anyway, just any reactions to that?
Yeah, the part that is. I think the part would have to a couple of comments. Number one, I think when there was warnings of the previous time there were warnings of the recession coming, I think a lot of companies, a lot of startups at least, were preemptively cutting down on spending, stretching out their burn, etc. So stretching how long they could live with the same amount of cash. So they were almost acting as if they were in a recession, even if there was no recession. So I think it helped them skip if there had been a recession, but there was, as you say, no recession. I think this time, particularly with the new budget bill, and I think there's still a lot of back and forth. I think the Senate has introduced a lot of changes that the House doesn't agree with, so we'll go back and forth. Who knows what comes out of it? But I do think a lot of these cuts to Medicaid and Medicare, and I think what they call provider taxes, all will ultimately really impact. It's going to make the difference between the haves and have-not even bigger, right? So the rich AMCs who have like the MD, if you're MD Anderson, you're not going to be in trouble. Yes, you're going to be hurt by the federal funding slashing. But if you're a rural hospital, it may make the difference between life and death for you. And so I think there's going to be a lot of rural hospitals and smaller hospitals who won't survive this cut, who are just barely hanging on. I think 12 months ago, there was a statistics that 53% of health systems and hospitals operate in the red. You start cutting out this Medicaid and Medicare funding, which in some cases is 50% of their revenue. They're not going to make that up. So I think there are lots of hospitals and providers who are hanging on by a thread, and this will be cutting the thread for them. They will not be hanging on anymore. Steve, you're on mute.
So that's concerning from a lot of perspectives. From a young company software perspective, it means that already it's the case that hospitals do not feel rich and spendy and are not making a lot of discretionary spending on software tech. And this just further compounds that issue for young software companies. They have an innovation. It has a clinical or administrative or financial benefit, and the hospitals just aren't in a spending mood. And that could be further compounded by these cuts you're talking about. Well, good. Well, so, and then any other thoughts on the macro environment, Marco?
I think when you're a startup, I think, so when I worked for Michael Porter, one of the things he always said is it's very important which opportunities you pursue. It's more important to pursue the right opportunities, because if you pursue the wrong opportunities, you can be as good as you want, but it's going to be a miserable day most of the day. So pick your right opportunities. And I think that is within healthcare and life sciences also the case right now. To your point, if you're going to support and you're doing something very meaningful, but it takes, let's say, 12 months plus to get an ROI for a healthcare provider, and it requires some significant CapEx upfront, it doesn't matter how good your solution is. It can be 10x better than anything else out there. They're just not going to buy it, or they're going to die on the vine while they're trying to make it work for you, right? So try to really align with where are the pockets where there still is growth. There is definitely AI. One of the reasons why there's so much interest in AI is because, number one, can it drive down cost? Can it improve speed, efficiency, reduce burnout, etc., all at the same time? So it improves my bottom line and it makes my employees happier and maybe my patients happier. Wow, that would be fantastic if I could do all of that at the same time. And at the same time, it's also the organizations are not, they don't really quite know how to use AI at this point. It's still very young, very early. And then I think the pharma companies, they are spending where it's easy to get ROI, but I think some of the harder and more exciting problems are where it's a little bit harder to make the ROI happen. But we can talk more about that in a little bit.
Thank you. Yes. So now for our audience, feel free to throw in questions about the macro environment in the chat. And now we're going to move on to a trade journal section of the show where we talk about stories that appeared recently in trade journals. And I'm going to jump into the story of recent IPOs. So the IPO window has been closed for 3 years. That's really bad news for the innovation economy. And the reason is that we need the whole capital food chain to work. We need investors to want to invest in young companies. Then we need those young companies to exit and give returns to those investors. And then we need those investors to like the sector and put money back into the young companies. And there's 2 ways to exit. There's a trade sale and IPO. And the IPO window has not been open. And so you've got companies that are pushing 9, 10, 11, 12, 13 years they'd like to IPO to give liquidity to investors, and they have not been able to IPO. And so now the whole IPO window is closed. It's closed for biotech, it's closed for digital health, it's closed for other sectors as well. And nobody expected this, but it was digital health unicorns that led the opening of the IPO window, if it's open. And I'm going to try to give a view on that. And so Hinge IPO'd to great fanfare, really interesting company. It has the potential to be a bellwether and a standard for digital health. And Hinge is up 20% from IPO. And that there's a kind of a rule of thumb in the past that that what you need to have happen if the IPO window is closed is you need a high quality company to go out and IPO anyway, and then you need a stock price to go up 15% and stay up. And if that happens, then there's many other companies waiting in the wings, and they will jump at the chance to go public as well. Hinge followed that rule. It's up 20%. It's a profitable, it's a positive earnings company. It has a good growth story. There's buyers like the product, and its stock's up 20%. So that's the good news. The bad news is that Omada, which is another standard bearer for digital health, also IPO'd. And they are very well known. They're similar to Livongo in a lot of ways. They sell to payers, also a little bit to employers. They sell a diabetes solution. They also have other chronic care management solutions. And so this has the potential to be this is what a lot of digital health startups were about in the last 15 years, was this kind of stuff. And Omada has the potential to be a real standard bearer. And Omada's down 27%. So it came out, it went up, and then all of a sudden it took a lot of punishment in the market. And this seemed to be on no news. So I think Omada's margins are not as good, but that was known. There's no surprises in their margins. And I think they're not as profitable. But then seemingly on no news, the stock gave up its gains, and then fell 27% below its opening. And so I'd say it's not clear. It's not clear. So what we want to be able to say is that the IPO window is open, and that that there's going to be many more digital health unicorns will exit through IPO and be well received by investors, and their stock prices will go up after the IPO. That's what we'd like to see. But I'd say it's too soon to say because of what's happened with Omada. And then I am hearing talk there might be some other IPOs in the works, but nothing concrete. Things get very concrete when there's a roadshow by a top investment bank who's asking book questions. They're asking, can I get commitments to fill out our book for the IPO? And valuation levels are being mooted, and so I haven't heard that yet for another stock than these two. So this is a big deal for stock market, big deal for digital health. I'd say that it's too soon to say. I wanted to have positive news amid all the bleak and negative news that we've had for years, but it's too soon to say that there's positive news here. So Marco, any thoughts?
Yeah, absolutely. And it's ironic because that we're doing this today, because I think today SwordHealth, a competitor to Hinge, announced private funding at a valuation that's $1 billion higher than Hinge's IPO price. So I'm sure that is not coincidental. And I think that is probably a question is IPOing the right route to go at this point? Is the IPO window really open? And I can imagine, as we just talked about earlier, if you are an exciting new company, you want to have good coverage and you want folks to be on you. And when all the other things around you are moving up and down as much, you can get snowed under a little bit, right? So, so to your point about no news, maybe that's partially what kind of gets you dinged a little bit, which is, not how it should be, but it's possible. But yeah, I think it's difficult and it is critical because ultimately once the IPOs get going, the VCs feel more confident. They figured out how to exit, right? And big through an IPO and not of M. And that gives them also confidence to then that's kind of the harvesting part. That gives them confidence to invest again. But if they don't know when they will be able to harvest or how big the harvest will be because the IPO market is kind of fuzzy or soft, then they're also going to be much more hesitant. And that's what I hear, right? Due diligence times take 2-3 times as long. They reject companies that otherwise they would have funded. And so they are, it reminds me a bit when I was at Roche, there was a saying that we're happy to overpay if it means we have to wait longer and take more risk out of the deal. And I think that's a little bit what investors are doing now as well. If the IPO window is not open, they'll just wait longer. And then I don't care if I paid a little bit more, but now I'm more certain that you are the winner. And I don't want to take a risk. So it is not good for startups that rely on external capital. So, and I think what I am hearing too is that there are startups, including larger ones, that really have focused as a result of it more on profitability and kind of sustainability, because then they become less dependent on this cycle of external capital. So I think that is a kind of ripple effect of that.
Yeah, it's worth. Thank you. It's worth dwelling a little bit on what's so great about being public. So historically, you got a higher multiple for being public. So that alone was a reason to go public, and that was for multiple reasons. But another reason was there was liquidity in your stock. Anyone, anytime could just go and buy some of your stock or sell some of your stock. There's people, there's brokers making markets in your stock. There's equity research analysts publishing pieces on whether your value is justified, whether your stock price should go up or down. So there's liquidity that's very valuable for investors. There's also, you get a new currency. You can go around and buy a company with 25% cash, 75% stock, and people know what the stock is worth and can expect it's going to retain its value because you're a publicly traded company and the stock's priced in the market every day. But there's also a disadvantage of that it adds a layer of complexity and cost. It might add more than $1 million a year in extra costs to the company. If you're not big, that could be a significant drag on your earnings. So there's extra cost, and that's often associated with the so-called Sarbanes-Oxley reforms that added a lot of requirements and paperwork to the process of being a public company. And then easier access to capital. Traditionally, it's been the case that if you're public, it's easy to access capital, and if you're private, it's not. So there's a number of reasons to be public. But what we've seen, I say unexpectedly over the last 10 years, is that the private markets, so here we're talking about VCs holding equity and also private equity firms holding equity, have become incredibly efficient. They're paying prices equivalent to public market prices often. So that means there's no longer an advantage to going public. You don't get a higher multiple for going public because you could be bought by a private equity firm for a similar multiple. And then interestingly, it's all private, but you can now get some level of liquidity. So there is a market of people going around buying and selling shares in these private young companies. The company's 5 years old, 10 years old. It's won in the product market. It's seen a lot of gain in its stock price. And then insiders can get out and outsiders can buy shares in it on these sort of private exchanges. So then there's so many private equity firms that you might be able to raise capital as easily as a private company, as a public company. And in fact, the IPO window has been closed and equity financing has been harder on Wall Street. So it just might be easier to get private financing than public financing. So it's by no means, and then you don't bear the Sarbanes-Oxley high cost burden of being a public company if you're private. So, and part of the reason for that is that it's assumed that the public includes retail investors who are not sophisticated, need to be protected by the SEC from the possibility of misrepresentation or fraud. If you're private, everybody's a sophisticated investor, and so you don't need the same safeguards when you're private. And so that's why there's that distinction there. So we may see that the private markets become as efficient, maybe more efficient, as big, maybe bigger in the future than public. Anyway, I don't know if you have any thoughts on that.
Yeah, a couple of comments. One is that I think I remember being at Affymetrix, and one of the downsides that we saw of being a public company was that our customers, we were selling very expensive deals, right? And like a minimum was like $500,000, oftentimes many millions. And because of the deal size, the buyers became sophisticated and understood that we had quarterly numbers to make. And so I remember talking to the CFO back then. This was a while back, but nevertheless, that 80% of our deals every quarter happened in the last 2 weeks of the quarter, because they knew that we were up against with our backs against the wall and we were going to try to make our numbers, and we were giving the heaviest discounts possible. So even if they were speccing out everything they needed, vetting everything they needed, they would just hold and hold and hold and say, I'm ready to buy in the next 10 days if you give me an extra 30% discount. So being a public company also makes you predictable in terms of the metrics that you're going for, and people can kind of game the system, right? So that's one other part. And finally, I think yes, you're right. I think the liquidity here in Silicon Valley, I think there's some company that says a lot of folks were either leaving companies or want to just cash in on the options they have. They effectively finance your purchase of your stock options, and they get a cut of when you exercise the stock options. But if you work in a company, you have, let's call it $1 million or $2 million in stock options that you need to buy, and you don't have the money to buy it, an option like this can actually be very affordable for you. And so you do get liquidity without having to wait for an IPO. So I think you're right that the IPO is the only holy grail and home run is kind of diminishing, and other options are becoming more viable as well.
Yeah, thank you. So moving on to some other trade journal news. And for our audience, now's the time in the chat to just throw in any trade journal stories you want us to cover or your own angle on what we're discussing. So I'll mention, really interesting, 23andMe was long a darling of venture and of Wall Street. And then and so it was long considered to be a great success story and really filling out some of the potential. So people would take genetic tests, they would get information that was valuable to them, but they also would go into a registry and they would elect to say, you can use my data for research, and they would elect to say, you can contact me with offers. And so pharma would show up and say, I would like to know everybody who is genetically predisposed to have this condition. And and everyone who will accept offers, I'd like to make them an offer to participate in a study, and I'll give them $150 they are willing to, over the course of 3 payments, if they're willing to participate in a study. And this was marvelous. It simply didn't exist. This kind of data didn't exist. This recontactability of patients didn't exist before. It was marvelous, and it did succeed in generating revenue, multiple streams of revenue. And then it looks like they made some missteps later and didn't quite fulfill some of the promise, made some missteps, and suddenly they were in bankruptcy. And then all of a sudden, you had the prospect that a random company could buy 23andMe and have control of everybody's genetic data. And I actually bought 23andMe and tests, and then I didn't take it and didn't send it back because this weighed on me. At the same time, I think the California state killer was identified and caught using a genetic database, not this one, a different one. And I'm glad he was caught, but I still wondered, should my data be in some database somewhere? And so I never did it. And then here was this case. I think the Attorney General of the state of California gave a public plea that individuals were allowed to write to 23andMe and demand that they delete their data. And he recommended everybody do that. Everybody who writes 23. I'm not sure how many people got his message and then wrote the letter or whatever. But so now the new news is that 23andMe, which was famously founded by Ann Wosicki, an entrepreneur, she's now bought the company out of bankruptcy for a few $100 million. So that's interesting. It's not just some random stranger buying it. It's someone who had the original vision, to use the data in healthcare and get the value of the data it has in healthcare. So I would say this is a story of our times, a company that was once a high flyer and also was then a fallen angel, and then could have been sold to anyone who would then possess their data about millions of people, and was finally reacquired by Ann Wosicki, who may be able to buy it in bankruptcy at a low price and then make something out of it a second time. Any thoughts? But it sort of encapsulates a lot of what we've seen lately. So any thoughts on the 23andMe saga?
Yeah, I'll stay on the surface because I know Anne personally, so I don't know what is probably what's confidential. But I would say that I think she's convinced of what she wants to do, and I think she thinks that the public markets are not properly valuing it, and that's why she's been so adamant about buying it back. And so let's see ultimately if she's right or if the other market is right. Right. So the good part about entrepreneurship is you place your bets and you live or die by the outcome and how you evolve. So let's see what's going to happen there.
And then, so I like to bring to the audience stories of fundraisers and the meaning behind them. And I have to say, the last 2 weeks, I have not seen a lot of new fundraise announcements. And I think what we're seeing here is what I'm hearing called the Trump pause. And the Trump pause is that, usually for any deal to get done, somebody has to be pushing hard to get it done quickly, and everyone else has to go along with getting it done quickly. And instead, you're having at least some of the players, such as the venture investors, are saying, I can just wait 30 days or 60 days or 90 days. And there's going to be more information. We'll know stock market levels. We'll know other things. And so I haven't seen that many fundraisers. I think I'm attributing that to the Trump pause. But one very positive one was Ellipsis Health is a company that uses AI voice agent technology, announced it had raised a $45 million Series A. The CEO is Mainul Mondal. The syndicate includes Khosla Ventures, Salesforce, and CVS Health Ventures. So Khosla has really shown itself over time to be an independent thinker. So they would go and do a deal when the time is right and not delay because other people are delaying. And Ellipsis Health uses vocal biomarkers to identify mental health disorders like anxiety and depression. Yeah, that's really interesting. There's ways you can use those vocal markers on your smartphone where it's listening to you, but not the other party in a phone call, or it's asking you to speak, or it's measuring things like how quickly you respond to your friends in email or your friends in texting. And there's these intriguing ways that these can be biomarkers, and you can actually identify mental health disorders there. So I think that's one of the few fundraisers. You also mentioned Sword Health raised $40 million at a $4 billion valuation, remarkable. I think what we're seeing here, number one, is an AI story in Ellipsis Health, and we're also seeing a sort of a flight to safety in the Sword Health deal, which is that investors would love to put money in a later stage deal that perhaps is profitable, likely to go public. It's a safer bet, a sector leader, rather than make true risk capital investments in companies whose product has innovation but hasn't really taken off yet. So that's kind of the lesson I'm seeing from these fundraisers and the lack of fundraisers. So any other thoughts on trade journal articles and fundraisers?
Yeah, I'll come back to the trade journals in a second. I think on the fundraising side, one thing that I want to call out is kind of what I call the longevity or the proactive health care funding pocket, a mini boom. So it's maybe not a Trump boom, but I think it is the people who vote for Trump maybe. And what I mean with that is the people who are wealthy and healthy enough to invest in their own health, right? They don't wait for sick care. But if you look at Prenuvo, raised $120 million recently. Ezra and Function, I think, merged, and I think Ezra announced a $20 million funding round. Neko in Europe announced a big funding round. Superpower, I think, is also going after this market. They announced a $30 million funding recently, and Commons Clinics also raised $26 or $30 million. So between those 5-6 companies, we're actually looking at a few $100 million. And Pernuvo, I think, publicly has stated that they made $100 million last year. They were profitable. And so, yes, I think that's what the others probably will go after too. Now, I think what is interesting is that this is where, so I do believe very strongly in proactive health. I do very strongly believe that whole body scanning, I'm going to call it that way, because things like NECO are not a whole body MRI, but you see several combinations of whole body MRI, CT scans, lab tests, basically with proactive broad scanning, discovery-based scanning to catch diseases before they hit you, right? Before they become a sick care. That's what it's really about. And they all have different approaches to that. So I think that is a market where there's a lot of what I mentioned earlier, Michael Porter. This is a market where I see a lot of opportunity. And it starts, think about how Intel always thought, right? Andy Grove always said, in the beginning, we make 80% margin on $3,000 per unit. And then gradually we make 50% and then 10% as the price comes down. That's what you should expect here as well. We're in the very beginning where these companies, I think Pernuvo and Ezra charge $2,000 to $3,000. I think Pernuvo now has one that is even $4,000. So that's not mass market. That is top end of the market, but there clearly is demand for it. And of course, it's a question of, well, when will it come down more to the mass market? So that's on the funding side. There are still bright spots. On the publication side, I want to very briefly call out one report called 2025 Future Ready Healthcare Survey Report by Walter Kluwer. As I said, I'm Dutch and Walter Kluwer is Dutch, so I have to call that one out. But it's about what's really happening with GenAI, and I think this is part of the topic of conversation today. And the interesting part is when they ask in the survey, what's impacting your healthcare organization over the next 3 years? A lot of it is not about should we use AI or GenAI or yes or no. It is about what are the regulatory changes about using it? What are the implementation challenges that we use with it? How can we use it for professional development and clinical training, etc.? So cybersecurity preparedness, those are all the ones that are in the top. And I also mentioned that time spent on electronic health record is at the very bottoms. But I think that's the point, right? I mean, people have high hopes for AI, but how to make it happen is not that easy. And so that's one thing that they're really struggling with. And that's where the next challenge is.
Really interesting. Thank you. Yeah. So I myself have been engaging with a lot of the companies around the longevity space. And I find it really interesting. And I've talked with friends. It seems to be going through its own kind of singularity of interest right now. And I'm trying to figure out why that is. And I heard some interesting answers from some friends. Well, first of all, this market, there's a couple, it's hard to understand the longevity market, but there's longevity biotech, which is typically drugs for the big chronic conditions, a drug for diabetes. GLP-1s are claimed now to be the first ever approved longevity drug because they address conditions that get more serious as you get older often. And so there's longevity biotech. There's longevity medical care. That is like going to a longevity primary care clinic, for example, where you have a clinician is treating a patient. And then there's also longevity tech. And so this is software companies usually selling direct to consumer that help you track your data, manage your life, make better decisions, predict your health in the future. And we're watching, and that's like, I think Function Health is more in the longevity tech space. Superpower is more in the longevity tech. Inside Tracker, which has been around for a while, is longevity tech, that sort of thing. Sometimes they're in multiple these categories. And this has been undergoing a lot of consumer interest, followed by a lot of entrepreneur interest and a lot of investor interest. And I think it's because, believe it or not, podcast shows like Andrew Huberman and Peter Attia and others, they have identified, grown, concentrated the audience for these things. So in the past, if you had a product like Superpower or Inside Tracker, the marketing challenge of finding the 1 in 1,000 people who wants to spend money on this was enormously expensive. Or you take out an ad in Time magazine, what are you going to do exactly? And so I think that the podcasting has allowed long tail creators to attract significant audiences. And then that in turn, they now become a marketing conduit. So you can now market Superpower to well off people who are relatively healthy in middle age who care about their future health, and you could find them, but you couldn't economically find those people before. So I think that's part of why we're seeing this little boom, is that it's been popularized by certain influencers, if that's the good term for Peter Attia and Andrew Huberman, and they in turn can do what they can do because of technology change, because no one's reading Time magazine anymore. Everyone's listening to specialized podcasts now. So
I think that's true. I think there may be and I'm just speculating here, but there may be a demographic effect as well, right? I mean, if you think about it, there is, of course, a category of, you know, the Wall Street traders and so on, and want to just stay in, like American Psycho, right? Stay in super shape and all that kind of stuff. But there's also, I think, a number of people who are seeing their parents who are hitting maybe the late 60s and 70s and starting to break down and say, why do I want to go down that same track? What can I do today to be in better shape when I hit my 60s, 70s? So they're maybe in their 40s, 50s. And that means they probably have money to spend, and it's still not too late for them to delay. I think Eric Topol talks a lot about longevity is about really two things. Number one is delaying the onset of disease. And when you hit these age-related disease kind of milestones, can you slow down the rate of disease, right? So it's almost like slow it down and lower the intensity. And if you can do that, you can add, according to him, something like 7 years to your life. For most of us, if we're in our 60s or later, if we can tack on an extra 7 years, that's a lot of time. So you can maybe really see your kids graduate, have kids of their own, etc. Right? So I think we're in the point where there's a pocket of consumers who are both able and motivated to actually do. Take action, and this is an avenue for them to take action.
yeah, interesting. Thank you. Yeah. Well, good. Well, so now we move on to the next part of our show, which is just this is an audience favorite, but it's what is a technology use that's improved your life somehow? And so I'll just mention something that our audience may not be that familiar with, which is that there's kind of been a revolution in chargers, and I'm going to focus on car chargers this time. So there's a revolution in devices. You plug them into an electric power supply, and then you charge your devices. And of course, today we have bigger devices. Our iPhones have bigger screens, burn more battery juice, need to be recharged faster and with more electricity. We have iPads, we have other devices. And so what I want to call, and what's happened in return is that you're seeing chargers, wall chargers and car chargers that are just 10 times better than what we've seen before. So I'm going to call out that on Amazon, you can get for like $40 or so, a car charger that goes in that circular 12 volt, cigarette lighter socket. But this one converts that to 4 USB-C slots with a sum total of 240 watts. Don't ask me how they do this, because usually that car charger can only give you 120 watts. And then you have to run the proper core USB-C cables that are rated to carry that level of wattage. But the end result of this is that you could have four USB-C cables coming out of their charging devices for 4 family members. And some of them are rated as much as 140 watts for a single one of those slots. But you have to have a new modern charger, and you have to have new modern USB-C cables that are rated to carry that level of wattage of charge. And so, but you just couldn't do that in the past. So now your car becomes one of the best places to charge all your devices, and will do it for you and your spouse and your kids all at the same time, instead of there being a pathetically slow charge coming out of your car. So so you can get these today, and then you have to get the right USB-C cables for them, which is a headache because USB-C cables are usually not labeled well, and so you don't know. But it all defaults down to the poorest qualities. If the cable was made 5 years ago and only can carry a 20 watt charge in it, then it will only charge at 20 watts. Whereas the outlet, the charger in your car could be pushing at 140, for example. Anyway, Marco, do you have any tech that's affordable to our audience that's improved your life?
Wow. Well, I will say I'm going to go out and buy that device that you just talked about. I was not aware of that. Yes, I have exactly as you say, the drip wireless charging in my car, both cars. And this sounds like an amazing device. No, I'm still kind of a late adopter in this respect. I mean, I'm using more kind of cloud AI and Perplexity. I think Perplexity is really good for organizing information, for sourcing. Cloud AI, I think also what I like is they'll explain what I try to do is this and that, right? So I really like those tools. Car technology or anything like that, no, I don't have anything to offer in that respect.
And there's also wall chargers. I think that there's some term like the new generation is called gallium nitride. So look for that. But to give you an idea, there's a wall charger by Anker. They make a lot of the stuff people in the tech community like. And a couple of years ago, a top-end Anker wall charger charged at 60 watts, and now a top-end Anker wall charger charges at 150 watts, and it's using the gallium nitride technology, and they're small, they're smaller, they do more, and they do it faster, and they're smaller than the stuff of just 2 or 3 years ago. But you have to use the right USB-C cables, or you'll be frustrated and say, why doesn't this work? So anyway. So let's see. So next, I'll just mention. So what are upcoming conferences? We're entering the slow summer months. There's not a lot of conferences. I'll mention Bio's going on in Boston. That's a big biotech conference. It's not a big software conference. About 1 in 20 people there. The software is a big part of their job for about 5% of people who are there. It's hard to find them, but it's worth it to find those people. You know, the pharma corporate venture fund investor who invests in software as well as investing in new molecules, or the commercial leader who buys Viva and other digital health software products and that sort of thing. They're there. But any other, and then there's not much else for the summer that I'm aware of. Do you have any favorite conferences that are coming up in the next month or two that you want to tell the audience about?
Well, first of all, I think AIP is going on right now, isn't it? So I think AIP is a big one. When I was at AMI just 2 weeks ago at Stanford here, AI for medical imaging, Chu O'Keefe from Define Ventures was mentioning that they had done extensive research amongst pharma, payers, and providers. And they said there was actually payers who seemed to be the most attractive ones for tech companies from the perspective that they were open to buying. I think pharma was more trying to build in-house, and providers were just so cash-strapped that they couldn't buy anything. So there was that. And I think the one part that is, I would only say with payers is be very careful because I remember, so a long time ago, I'm going to date myself here. I was involved with Health to Pedo advisors, of Health to Pedo, excuse me. You remember Matthew Holt and Indu Subaya, right? And so I do remember talking to a payer who I will not mention because of what I'm going to say next. And I had basically set up a matchmaking service where big companies like payers could tell them what kind of startups would I like to meet? And we would basically vet and present the 10 best startups that met their profile, just a little bit like what Vive is doing. And I remember their explicit intent was very simple. Learn from them, do a pilot with them, and effectively reverse engineer everything they could. Now, this was a particularly predatory payer, but nevertheless, I'm not sure if it was the exception or the rule. Who knows? So I'll leave it there. In terms of events, I think Venture B-Trust.
There's one other predatory practice, which is when the health plan also seeks to leverage the balance sheets of little startups as well. Can't you finance this for us? Can't you bear the risk of this? The poor startups trying to sell to these health plans. So anyway.
Yeah, no, 2 comments to make on that. One is that, I remember from later on, I had someone who used to work at that payer worked for me in a different startup. And he said, so one of the other strategies they had is to make them your largest customer. And then they would basically say you have, let's call it $20 million in revenue, but they are 12 million of the 20 million. And like, I'm only buying you for the other 8 million. I'm not going to count the 12 million that I'm paying you. I'm not going to pay you twice, right? I'm not going to pay you for my own revenue. So the revenue multiple was getting hurt by actually doing a lot of business with them as well. So, and to your point there at the end, I was at CHAI, Coalition for Healthcare AI, summit. And I did hear that quite a few startups are starting to effectively offer equity in exchange for getting a pilot going, getting some early programs going with them, which is exactly what you're saying. You're effectively financing off your balance sheet, which is not great to do, of course. So I think, and to be honest, it's also a bit of a litmus test, right? If you have something that's really valuable, they should be able to pay for it. If you need to get into creative financing arrangements, then that's maybe a different story. So I hope you don't have a background noise. I'm sorry about what's happening here. In any case, there are two other parts, two other organizations. One is VentureBeat Transform. So VentureBeat Transform is coming up next week. This is all about AI and how is AI transforming healthcare life sciences and not just healthcare and life sciences, other verticals as well. And then my old stomping ground, Roche, is organizing two conferences next week in Basel. I wish you could be there as well, but time travel and being in multiple places at the same time is not possible. But they have one on biomarkers in clinical trials and other on larger clinical trials innovation in Basel. I think the first is 23rd and 24th, and the other is 25th and 26th of June. So both of those are next week. I would say those are very good top people. Or I think the good part about particularly the Roche conferences, these are people who are actually doing it, right? So you sometimes hear people who do spend a lot of time talking at conferences, and then and people are actually doing things back home in the office. These are the people who are doing it at Roche, Novartis, various other places, and so it's a good place to go there if you are a startup and you have tech that is ready to work with companies like that.
That's great. So moving on to personal notices, this is a chance to just talk about things you're up to, availabilities to be seen or to meet with our audience. And so I'll mention here that we talked about longevity earlier. I am hosting a longevity picnic in Boston on the Esplanade on Sunday. That's Sunday, June 22nd, coming right up. And it's the Boston Longevity Picnic. And it's done in cooperation with Longevity Global, which is a bunch of longevity bio professionals, and also in conjunction with Don't Die Boston chapter, and that is the Brian Johnson organization. And so we are going to have a healthy picnic, and then we're going to do some guided meditation, and then we're going to have some easy yoga. It's just a chance to get out and sort of practice what we preach and do something healthy. For the audience, just write to me and I'll send you the link for that event. And then also coming up, the next show is going to be Wednesday, July 16th. And the topic is the revolution in obesity care with Sloan Saunders of Flight Health. So Marco, any availabilities or personal notices?
Yeah, so I think for me, I recently taped another podcast called Health Tech Heroes, and that episode is coming out soon. So that is coming up imminently. Other than that, I think it's been a very, very busy conference season. I think there was a crazy week where we had Raise Health, Amy, Chai, five conferences at Stanford in 5 days. So, but I'm glad that it's all behind, and hopefully things will pick back up again after the summer and after Labor Day and so on.
Great, thank you. So, jumping now we'll move on to part 2 of our show, which is the main topic, and I'll just kind of set the stage here a little bit by mentioning that it seems like GenAI business models are about intelligently converting free data into structured fields and making decision and taking action. And that is different from and puts them ahead of older digital health models, which were workflow automation powered by SaaS business models. And when we look back at the prior generation of tech, and I would date it as lasting from 2009 when the Fed cut interest rates to about 2022 when the Fed raised interest rates. So we had this long run, but coming out of it, we don't see a lot of transformational new tech hospitals. Instead, we see the same old hospitals, and we don't see a lot of transformational new health plans. We do see a few new health plans, but we don't see a lot of transformational new health plans, and we don't see a lot of transformational new pharma companies powered by the older generation of tech. They may be powered by new molecules, but they're not powered by the older generation of tech. And then we also see that bellwether tech companies in healthcare, like Teladoc, are not doing so well and are not trading at such high multiples as they were in the past. And so what's going on here? What's the story on the prior generation? Why are we not seeing the results we might have expected back in 2009? Then what's different about GenAI this time around?
Yeah, very interesting. And I think I can certainly, to your point, I see many wishful references to the ZIRP period, right? Zero interest rate period. So, which is, I think, the period that you're describing. But that time is behind us. I think if you look at reasons why the old digital health business models failed, I would put them in maybe two, there are many reasons, but there are two kind of buckets. One is around CAC, customer acquisition cost, and the other around lifetime value. So if you think about it, a lot of, there's been, to your point, this is still the same providers are around, and there's a lot of non-invented here barriers to adoption. Many times, even when we go out and we build stuff and we are, people independently at Gazoon, for example, we hear independently from folks like you're 2-3 years ahead of the market. And yet we go to an organization and I'm like, oh no, I can build that. Sure, if you take an endless amount of time and endless amounts of budget, you can get in a few years to where we are today. But if you want to move fast, now would be the time to simply buy. So these non-invented here barriers to adoption are kind of killers for your CAC. They really stretch out your and increase your customer acquisition cost, which puts a big burden on high lifetime value on the back end after these high costs up front. I think the other part too is many companies are stuck, digital health companies are kind of stuck in innovation purgatory, meaning they are interesting to the innovation people, but they are not moving the needle clinically or operationally or financially. And so then you end up in this pilotitis where you have death by 1,000 pilots, basically. And again, that kills your customer acquisition cost. It just increases it to the point where it's very hard to get a positive ROI out of it when your costs are that high. I think the other part too. So, and by the way, on that note, if you think about the two companies that are doing well, Hinge and Sword, they went after markets where there are no large incumbents. That was a very fragmented market where predominantly the players are very small. So they do not have these non-invented hair barriers to adoption. They do not, physical therapists do not typically have a team of engineers to say, I can rebuild what Hinge did, right? So it just doesn't happen. But at providers, you'll see that. At pharma companies, you'll see that. At payers, you'll see that. They do have these engineering teams. So find your right opportunity. Then on the lifetime value part, I think for many digital health companies, there's just very low barriers to entry. I used to have a consulting business that was basically, I would frame it this way. Most pharma and payers would come to me and say, I have 300 companies who all sound the same, look the same, make the same claims. First of all, how do I know which are the 3 to 5 who are actually doing something exciting? Second of all, if 300 companies can do all the same, then is it really a commodity or is it really something innovative, right? And so that kills your lifetime value if you have no defensible moat. And I think one other part too is similar to that point that I just made, because there are so many digital health companies out there. There was no regulation, no standardization, no way to gauge how good or bad these companies were. There has been a lot of contractor consolidation. And so there's been a lot of efforts to cut down on point solutions and ask if they have, let's say, 1 or 2 very large partners who they count on, then can you offer that little point solution as well? Even if it's 50% is good, it's fine. I don't have to go to adopting a whole new company. So I think for digital health companies, it's been really an uphill battle because their economics are soft in general. For many of them, I should say, not for all of them. Like a company like Innovasor has very strong, but that's the exception, I would say, not the rule. And so there's all these challenges that I just mentioned. I think why is GenAI different and why is life different for GenAI companies? Well, first, there are maybe 3 or 4 reasons. Number one, we have mega companies, OpenAI, Anthropic, etc. They're building a layer of foundation models that basically lift up every company in the space, right? And they're investing billions and billions of dollars. So it's every AI company can sit on top of that wave that's growing and leverage those billions of dollars that are being invested. And digital health companies did not have that benefit. There was no one building an infrastructure or building a blueprint for digital health companies. So I think there's that. The second part too is I think there's general excitement for GenAI. It's really perceived as potentially transformational, right? I think the frustration that I sense when I see all these providers talk about how they find it hard to make AI work in their reality, in their environment, is not that they're frustrated with AI. It's frustrated that they feel that there's this enormous benefit that's really hard to extract the value from. But they start off at the point is, I believe there's enormous value here, right? Whereas I think with digital health, there was at some point digital health fatigue. Hey, it's first it was internet, then it was mobile, then it was this, and it was that. Internet of Things. When is this really going to lead to a payoff, right? So there was kind of a fatigue, whereas over now here we have an excitement. And I think as a result of it, also AI is perceived as almost inevitable. Everyone is using AI, or we're already using, all of us using AI on our phones, on the internet, and in our work as well. And so AI is transformational. It's inevitable. and digital health is often perceived as optional. And so your battle is very different when you're optional versus when you're inevitable. And so I think it's a very different time for Gen AI than for digital health. But it's exciting. It's also fraught with risk. And I can tell there's definitely a pent up situation where lots of top level execs say, I want our organization to be really aggressive with Gen AI. And then the people one level down are like, but how? I don't want to do something and introduce risk into the organization. So I don't want to do the wrong thing, but I also don't want to do nothing. Now what? And so there's and that's why you see a lot of talk about AI governance. And what that really means is, how do I translate that from strategy to people to processes, operations? All of that is clustered together as AI governance. So that's really the challenge of today.
I've heard stories in the enterprise of one worker figures out a way to do a job better, faster using GenAI, and then he hides it from his employer because the employer wasn't clear whether he's allowed to use it. He's worried about things like, I put some information in Google Gemini. Does that mean I revealed confidential information and Google now owns that and might use it against us? I don't know. But best not to tell anybody that I did this. And then there's also other people who discover how to do things more cost effectively, faster using GenAI, but there's no corporate company mechanism to share that with others. So they did it. And so now there's one person who knows how to do this, but they're not leading a lunch and learn luncheon on Friday to explain this to others who are receptive to hear it. And because the company, the enterprise just doesn't know, and oftentimes a top-down teacher is not going to discover these opportunities, but the person who actually figures it out in their job has no opportunity there's no mechanism to share that with the rest of the companies. That I've heard stories like that. Now, when it comes to the older generation, which is often workflow automation with a SaaS business model, I once heard an interesting analogy, which is that technology, it sort of shocks industries. So in the recent past, we've seen the World Wide Web was a technology that shocked industries. Remember when, everyone was wondering whether Staples online would beat Amazon's stationery department online, and Amazon was riding the wave of disruption as Staples was reacting and had what seemed like advantages of bricks and mortar to it. But so the web was a wave that shocked industry. Mobile was a wave that shocked industry. Cloud was a wave that shocked industry. And then this opens up industry and it allows young tech companies to enter and figure out a way to add value either as tool companies, this is like Oracle selling software, or as business competitors. This is like Uber selling rides. Uber is not a logistics software company selling logistics software. They're a rides company selling rides and competing with taxi companies. And so, but the technology comes along and offers new, better ways of doing things. This creates a shock that shocks industry and allows a limited number of tech companies, a limited period of time to jump in and become tools vendors or become industry players themselves. And the issue in digital health is that it's so regulated that when a shock happens, the shock is not as disruptive. And there's an opening, but the opening is shorter and then it slams shut. And so fewer companies can make it in. And then also, because it's so regulated, only doctors with medical licenses can practice medicine. And so ultimately, you can't just disrupt healthcare. People wouldn't want to come to a brand new medical practice that used non-doctors, and it wouldn't be allowed to function in the first place because you need the doctors.
Yeah.
And so that's kind of an explanation for why software companies just were not able to add as much value and were not able to seize the commanding heights and remain established in them the way that other tech companies and other industries that we look at did. So I think that's an interesting analogy that because of the regulatory environment, the shock is dissipated and the industry doesn't open up as much, and then it shuts back up faster. So there's less of an opportunity to jump in.
Yeah, very short, Steve. There, I think a couple of comments, and also because you mentioned Teladoc, I think the personal experience where family member was studying. She was a student in Colorado and went home for the holiday season in Illinois, and she was trying to use Teladoc to get a refill. And because of the regulatory issues that you're talking about, it was actually really complicated, and Teladoc did not have it organized well on the back end. So she basically, yes, she got a consult, but with someone who couldn't actually prescribe in Illinois. I was like, well, then why am I getting a consult? Your whole purpose here is to get the refill. So it was very much so that, yes, regulatory has a big impact. And I think in the case of Teladoc, during the pandemic, the floodgates were open for reimbursement. And I already said I was at Roche at the time. It's like the moment the pandemic over, all the reimbursements will disappear. And they did. So, and with that, the market disappeared. The one part too, as you say, shock is actually very important. One thing that I'm seeing is the digital health companies were always told the only way you have a chance of succeeding is if you integrate with the workflow. And even today, you go to any hospital and they say, yo, if you don't integrate with the workflow, I won't even consider it. What you can see very clearly in AI now is that there is one part where people just say, yep, we'll do it. We'll just integrate and just make it better. And there's another group, I'm thinking Troy Tasbas at Oracle, Abhinav at Innovator. They're basically of the mindset of, no, that's the wrong. And I think Karen Singhal, I think from OpenAI, they're all basically saying that will actually be defeating the purpose of AI. AI is so powerful that it completely can redesign and create efficiencies at a scale that are massive. Basically, if I'm going to try and take the AI and put it back into the workflow that was optimized for a pre-AI world, it's like putting a Ferrari in the parking lot. It defeats the purpose. So there will be a real push and pull between those who want to redesign around the full power of AI and those who say, don't disrupt my day today and just make my day a little bit more efficient, right, with AI. And so I think there's definitely a big fork in the road there. And let's see who comes out ahead. But these are big times of change, I think.
So building on that, I think that healthcare is full of stories of terrible workflows for physicians. So physicians and other clinicians, these are some of our highest paid knowledge workers using some of our sophisticated IT and customized IT systems, and their workflows are terrible.
Yeah.
And so you might have a physician who has eClinical Works for their EMR, but then they need to view a medical image and they can't view it in eClinical Works. And so they have to get out of eClinical Works and they don't have single sign-on and get into a different system for medical imaging. And then they get a text message. Well, because that's the secure way that their peers like to communicate. But the text message is handled by Verizon. It's not integrated into eClinical Works. And then someone needs to pay a copay at the front desk. They pay a copay with their credit card. That's not integrated into eClinical Works. And so there's just this mess that they get a fax. They literally get a fax in this day and age in a medical office. That's not integrated into eClinical. They get it on paper in a manila folder handed to them by an assistant. And so what's interesting is that I have heard a thesis that GenAI is going to be the future single sign-on, single interface. And so you're going to have a chatbot, and in that chatbot, you're going to say, send a text message to my colleague, Jim, and it will engage with the Verizon text messaging. And then you'll say, show me any faxes that came in, and it will show you the faxes that came in. But now you really do have one interface, and it might be voice and typing text chat, and it's doing, and you don't have to learn the Epic interface, and you don't have to know the workflow, and you don't have to log into eClinical Works, and you don't have to. So that's an intriguing thesis that we're going to finally solve the problems of interfaces being hard to learn and workflows being cumbersome and single sign-on not being available, etc. Because AI will be our one interface, and it will simply do things for us. It'll know how to, and it'll do things for us. So interesting. So most people here on this call, when they hear GenAI, they're thinking of answer engines. They're thinking of, well, a year ago I was using search engines all the time. And that gave me 10 blue links. And now I'm going to use answer engines, and that gives me a 3-paragraph answer that actually answers my question without getting me blue links if I don't want them. But then the next iteration of this that people are talking about, but maybe we haven't used so much, is agentic AI. And so what is it? That's what's coming next. That's what all the large language model hyperscalers are talking about right now. What is agentic AI, and how does that fit in? And will we see digital health business models built around agentic AI and not just answer engine AI?
Yeah, this is fascinating. And I think this almost kind of is an extension of what you were just talking about a second ago. So I think years ago when I was at Roche and we were working very intensely with Innovator, they talked about the EHR, et cetera, as systems of record. And then you build on top of that systems of intelligence, which is exactly what you talked about, workflow automation, et cetera. I think what you're going to see next, and what you were talking about there a second ago, and this extends straight into agentic AI, is that there's a need for humans in the loop, for humans to engage with the system and sometimes retrieve information or sometimes input information. I think that's what you just described. What I think we are seeing with agentic AI is there are also processes where steps need to be taken, and I don't necessarily need to have a human in the loop. Right. And so it's if I can use the React model, the reasoning and acting model, actually, if I have an agent that follows certain rules, they can do things. And to your point, if then there are certain issues, they maybe can learn how to say, hey, I needed 5 data components to make this decision in terms of the next steps, but I can only access 4. How do I deal with this? Does the 5th one make a difference or not? Or can I just go ahead anyway? So the point being, where we're getting to is everything we're doing so far is about how we optimize how we engage with the data and the information and we make the decision. What I'm hearing is agentic AI is an opportunity to actually have some decisions offloaded to an agent. And then the question, of course, can you supervise the agent? Can you control the agent, etc.? But refilling prescriptions, as I just mentioned, prior authorization is a very human involved process right now. This is something where it's suitable for agents. And it's a combination of rules and exceptions. And again, this is what agents can typically deal with and learn. And so I think a couple of comments to make. For the clinic especially, agentic AI holds a lot more promise, I think, than Gen AI, but it's less developed. Why is it more upside? Because action is more ROI than just information. And the scope of impact is larger than Gen AI, than what we call Gen AI today. The challenges are that the longer the chain is, the more activities that an agent covers, the more opportunities there are for failure, the harder it is to trace and root cause analysis where the failure is. And I think more cybersecurity risk. If these processes are running in the background, how do I know that it's actually not getting compromised? Right. How do I monitor and control that it doesn't spiral out of control or that someone is tweaking it somehow or so. It's exciting, but also a little bit challenging. I think the other part too is one of the things that you hear a lot is when I talk to providers, they say, oh, we hear all these threats of, is AI going to replace the doctor? And what many doctors are saying, or many hospital systems are saying, which doctor? I'm short radiologist. I'm short specialist. I'm short of nurses. I'm short of all these doctors. I don't have anyone to replace if you wanted to. So if the AI can fill actually the void and take care of a number of actions that I currently cannot do because I don't even have the people to do it, then that would be incredibly powerful. So for me, that's why I think agentic AI is really exciting. I think on the care delivery side, on the R&D side, it's interesting that we're having this discussion today because just this morning, Christian Hein, acquaintance of mine, mentioned that Novartis is now using agents for generation of real-world evidence, and other companies as well are starting to use agents in the R&D process. So I think agentic AI is very visible and logical in the care delivery side, particularly on the administrative side. But I think it will creep more into clinical, and then I think on the R&D side, on the pharma side, it's coming as well. So it's an interesting time.
Interesting. And I heard a joke at Bio, which is I'm based in Boston. It's in Boston this week. And the joke was that it starts with a kernel of truth. And the kernel of truth is that there was a panel or something where a pharma supplier said that they are using agents for their sales process. And then a pharma purchaser said that they're using agents to negotiate with the agents from the suppliers. And so you have agents in the purchasing process boring, plain old purchasing process of contracts coming up for renegotiation every year, every 3 years. You've got agents negotiating with agents. And so that's the kernel of truth. And then the joke is that pretty soon this is going to consume first all compute and then all electricity after that.
Wow. Okay.
With no real, the actual purchase prices are not going to change that much, but it is going to consume all electricity. So then the next is, I just wanted to ask a question about regulation before the end of the show. So there was an interesting story that came out of in the Biden administration. The first was that Biden was trying to create a consensus in the US and Europe around restrictions on and some of this was the belief that AI would say politically untrue things that were damaging. That was some of it. But there was, and others was that AI, there's the paperclip maximizing philosophical question, which is that AIs could become a threat to humans because someone accidentally tells them to maximize the number of paperclips, so they turn all human-built infrastructure into paperclips and the people inside of them as well. And so there was concern about that. And Europe actually passed some regulations that have since caused the large language model builders not to release their latest models in Europe, interestingly. But then Trump came in and he swept a lot of this aside. And he said, we're in an AI race with China, and therefore we can't hold ourselves back. So there's a very different, very stark political change that happened with the new Trump administration here. But I'm wondering, what do you, and there was an interesting analogy that was raised by Biden in this multi-step process. But I say Biden, I mean more the Biden administration. But there's something that we're not strongly aware of, but that there are large fields of mathematics, physics, material science that are around topics like uranium and plutonium enrichment and bomb design in different shapes and sizes for yields and for performance. And these are classified, and it's illegal for people to publish research results. They exist. You have to be classified. You have to have clearance to read the paper. And so large areas were just classified and have been for 50 plus years. Where they are done in the US, possibly this extends to Europe, I don't know. But that same structure they were regulators in the Biden administration were realistically thinking of applying that to large language models, to transformer calculations, to the data and weighted models and that sort of thing. And they were, and that might have been coming down the pike. It isn't now, but it might have been coming down the pike. But that's an example of some of the regulation. But when it comes to healthcare, what do you think will be regulations? One thing I think is that with healthcare decision making, answers ought to be explainable. And with AI, they often are not explainable. The irony is you can actually be more correct more often, but can't explain yourself, and a human can be more erroneous, but the human will always be able to explain him or herself.
Yeah.
Another one is hallucinations. AIs are notorious for the possibility of hallucination. And also there's been a lot of concern around discrimination, that AIs may pick up on a perceived trend and declare that to be the truth or something, and they're actually committing discrimination. And another area is that when it comes to diagnosis, because of all the problems I just mentioned, that you don't want an AI to actually, the AI may do 60% of the work, the AI may do 99% of the work, but that a human, who's probably a doctor, is responsible for a diagnosis and care plan. And then if the AI was wrong, that the human plays the role of being responsible, and that has a court implication, but it also means that they make a decision to change the AI, to fix it or to adopt a different AI or something like that. So we need that human doing that. So what have you seen in terms of AI in healthcare, and where is that going to lead? Regulation of AI in healthcare, and where is that going to lead the sector?
Yeah, a few comments, and it's funny that you say that about AI being very certain, but sometimes completely wrong. I think there was a surgeon who wrote a book like "Often Wrong, Never in Doubt." I'm like, maybe she was ahead of her time. I'm talking about GenAI, really, or maybe GenAI is becoming more like surgeons. But in any case, I think when it comes to regulatory, I think a couple of comments to make. One is we need to remember that when it comes to regulatory, as we're talking about AI in healthcare and life sciences, it's largely focused on clinical AI, right? Not admin. Of course, there's privacy and things like that, but most of the regulatory flux is not on the privacy side, but more on the clinical AI sides. I think to your point, it freezes decisions, it creates confusion, and confusion equals delays. So it's very bad for startups. I think there is a bit of a push in the new administration to cut back on regulation because regulation is perceived as bad. I think Mark Anderson also talks about regulatory capture. Regulatory capture is obviously bad, and I think that's something that's happening in crypto. But in healthcare and life sciences, buyers and users must be able to trust and, as you said, understand the AI that they use. They don't need to know all the little details and proprietary secret sauce in your AI, but they need to understand that how to interpret the results of the AI. Why did you come up with this conclusion? They don't need to know all the secret details. And I think so if regulation pulls back or becomes more fluid, more fuzzy, I think you're going to see attempts to fill in the void. What I see is last year, and I was involved with Chai, but I've seen it also now at various events. There's a lot of talks about model cards and registries. Registries of models. Those are a compromise solution. I think they often say it's the food label of your AI model. I think that's a bit of an oversell. A food label, why does a food label work? It's very simple. It follows very objective standards. And, there's no question of interpretation. If I give the same food label to 100 different people, they come up with the same conclusions about what the food label says. If I give 100 model cards or the same model card to 100 different people, and we're going to get 110 different conclusions out of it, right? It's more complex. And it does not mean that we don't need model cards, but we should not think that we have the model card, therefore the problem is solved. It's just a step in the right direction, and it needs a lot more work. I think AI regulation going forward would ideally be lifecycle based. I think the January 7 guidance around this, I think lifecycle is what we need. This is an iterative AI. And I think we need third-party reviewer industry, just like in cybersecurity. In cybersecurity, you can say, if you want to know how secure or how well validated my solution is, I can put it to a third-party reviewer and they can give you an independent read on it. And I think that's what we need here in healthcare as well. So
really interesting. So that's the way that AI regulation is going. Well, good. Well, and we've reached the bottom of the hour here. Any other thoughts or comments on will the new generation of GenAI startups win in healthcare this time?
I sure hope so. I think I think the new generation of AI companies is much more focused on ROI very early on. They are also much more capital efficient. This is not the old buy an audience and monetize it later. And I think so. And then just leveraging what's happening from all the big players who are building the foundation models. I think we're on a very solid footing and very capital efficient in what we're trying to do in the new generation of AI companies. So I'm very excited. I think we are, as I've said, in the bottom of the first inning, maybe the start of the second inning. We have barely scratched the surface of what we can do, both in healthcare and life sciences with AI.
That's great. Well, thank you. So you've been listening to the Digital Health Investor Talk show with your host, Steve Wardell. And thanks to our guest, Marco Smit, the head of data and AI at Gesund. Thank you, Mark, for coming on the show.
Thank you.
And we're publishing this show as an episode of the Digital Health Investor Talk show. Subscribe on Apple and Spotify, and don't forget to rate us. And we'll see you on the next show. Thank you. Bye-bye.
Thank you.